No, that's this is the first question on every call, right?
Yes, we can.
So I'm going to be talking about DeFi concepts. Obviously, this is a really broad topic, and I could talk about this for hours. So in 20 minutes, I've condensed and just picked like the few really important topics I feel like everyone should have a good grasp on before they actually start investing in decentralized finance protocols or playing around with it. So the topics we're going to be covering is exchanges and the three different types of exchanges, being order books, AMMs, and aggregators. And then we're going to talk about arbitrage, which is obviously quite intricately related to exchanges. And then we're going to talk about liquidity mining, money markets, rebasing, and if I don't run out of time, a quick look at securities and like audits, because obviously that's quite a big thing in the space. Obviously, Paula touched on this, but please, if you have any questions, leave them in the chat. We're covering a lot of topics, so you'll often forget the question that you had when we get on to the next topic. So just pop them in the chat as we go. Right, and without further ado, exchanges. So what is an exchange? An exchange facilitates the buying and selling of supported assets. So if they list the asset, they support the asset, and then you can trade with it. There's two major types of exchanges, like overarching beyond like order books and all that, is a centralized exchange and a decentralized exchange. So all that means is a centralized exchange, there's a central entity that can control who can trade, how much they can trade, all that kind of stuff. And then a decentralized exchange where it's much more open and there is no single entity that can control or blacklist markets or blacklist individuals or anything like that. So the first type of exchange we're going to be looking at is an order book. So an order book allows one person to buy and sell with another person. So it's person-to-person transactions, right? So we have Alice here. Alice has 100 tokens that she wants to sell at $210 per token, right? So the market price now is $200. So she wants to sell at above the market price. And then we have Bob, who wants to buy some tokens, but he obviously wants to buy below market price, right? He wants to get the best price he can get. So what we have here is a deadlock. Neither of these orders will fill. But if you look at the bottom here, we have, oh, sorry, let me go back one. At the bottom here, we have a screenshot from an actual order book. So this is Coinbase Pro, which uses an order book for trades. So each of these little steps, let me turn on my pointer. So each of these little steps here is an individual order, like Alice's order or Bob's order. So as the prices meet, they will execute the trade, and then the price will move as the trades execute, right? So order books are quite common. There's lots of decentralized ones like 0x protocol, and there's centralized ones like Coinbase or Luno. So then we get to AMMs, which is really the fun parts of crypto. So an AMM is an automated market maker. So what this means is, you know, in an order book, Alice had to sell against someone else. There had to be someone else taking up the trade, right? In an AMM, you are selling against a smart contract. So you don't need to wait for someone else to meet your price, because the AMM, the smart contract, will automatically execute your trade. So here we have our lovely Alice again. So Alice wants to buy 100 tokens with DAI, right? So the current price is $2. So she's going to move the price to $2.50. So what happens in an AMM is it's actually a bonding curve in the background, but it's not technically a bonding curve. They have a different name for it because it's against two floating assets. But pretty much what happens is, so the market is going to lose 100 tokens because Alice is buying these 100 tokens. But the market is going to gain 200 DAI because she's paying for the tokens with that DAI. So what this does is it actually moves the price along the curve, which then obviously represents a new price. So the more tokens that are in the curve, the less the price is actually going to move when someone creates a trade. So AMMs are great because there is no other person. You don't have to wait for someone to execute on your transactions, but it can be bad because if there's not a lot of collateral in here, obviously the price is going to become inaccurate quite quickly. So I will cover the arbitrage that this creates when we get to the arbitrage section. So then we have aggregators. So an aggregator exchange pretty much is just looking at multiple exchanges, what their current price is, how much liquidity they have, and then it's executing your trade against multiple exchanges. So if Alice wanted to buy her 100 tokens for 200 DAI, what the market aggregator is going to do is it's going to look at multiple AMMs, multiple order books, find the best price for Alice. So for a buy, you would want it cheaper, and for a sell, you would want it higher. It would find the best price and then allow her to execute that trade on those platforms through just interacting with the aggregator. So it allows for really deep liquidity. So now we've covered exchanges, so you kind of get the concept of like buying and selling tokens and the different ways you can do this, right? But buying and selling tokens can move the price and make the price inaccurate to the rest of the market. So what arbitrage is buying and selling the same asset in different markets to take advantage of the fact that the price is different on different markets. So, so we have Jessica here, right? And we have market 1 and market 2. And in market 1, the current token price is $200, which is correct. That's what the market is selling it for. In market 2, however, the token price is $220. So it's off because, obviously someone made a trade and moved the price along. So Jessica notices there's a large price gap between market 1 and market 2. So what Jessica does is buys 100 tokens from market 1 at $200 a token, right? That's the price here. So she's spending in total $20,000, right? You can use flash loans for this or already have the token and all that kind of stuff. But just for this example, we're going to say she just straight up buys them for $20,000, right? Then what Jessica does is sells her 100 tokens in market 2 for $220 per token. So she's going to sell them for $22,000, which means she's walked away with a neat little profit of $2,000. And market 2 is now at the correct price because her trade will move the price back to the correct price. So arbitrage is really important, especially in decentralized exchanges, for keeping the price accurate. Because obviously every transaction is going to move the price one way or the other. So it's really important that there is arbitrage going on in the background, keeping these prices accurate so that you, the user, aren't left with an incorrect price. It does, however, create some perverse incentives because there's a lot of incentives for market manipulation, front-running transactions, transaction sandwiching, so that you force the price up and down in a malicious way. But yeah, so that's arbitrage. Right, so the next topic is liquidity mining, which has really started to pick up recently, and a lot of major protocols such as Uniswap has launched their own liquidity mining protocols. So what liquidity mining is it's paying a user to keep your collateral in a protocol, right? It's literally that simple. So here we have a generic protocol, right? GCP. So it's completely made up. So is token, as I hope you've all guessed, but it's just a nice example, right? So here we have a generic made up protocol that's running a rewards program, a liquidity mining thing, right? So Alice wants to earn these GCP tokens. So she adds her 100 tokens to the GCP protocol, right? Then in the total protocol, there are 1,000 tokens, right? So how the rewards usually are distributed is as a portion of the total pool. So the total pool here, including Alice's tokens, is 1,000 tokens, which means Alice is only 0.1% of the pool. So when they distribute their GCP tokens, the reward tokens, they reward them based on your percentage. So they usually reward them either weekly or monthly. They can do it more often than that, but obviously that becomes a bit tedious. So they're going to distribute 100 GCP tokens to all the people who are in the pool. Alice is only 0.1% of the pool, so she's only going to get 0.1% of the distributed GCP tokens. So she's only going to get 0.1 tokens from the liquidity mining, right? So this is great because it incentivizes people to provide liquidity to pools. So for example, a lot of AMMs do liquidity mining because they want you to put their liquidity, your liquidity in their curve, because then it's a deeper curve and the price is more accurate. The problem with this what does happen sometimes though, is that if your liquidity mining reward system isn't as competitive as another liquidity mining reward system, all these people who are providing liquidity are just going to go where they can get the most liquidity mining rewards. So it can make the liquidity in pools quite shallow because they might move from protocol to protocol as they introduce these liquidity mining rewards. Right. So the next topic is money markets. So a money market is allowing a user to create a fully collateralized loan, right? So if you think in a traditional market, if you want to buy a house, you go to the bank and you say, here's proof that I earn a salary. Can you please lend me the money to buy a house? And they're like, cool, right? That's a partially collateralized loan. So a fully collateralized loan would you be going to the bank saying, I have all the money to buy a house, please lend me the money to buy a house. So it's a little bit of a weird concept in the traditional sense, but it works quite well in the DeFi sense. So users lock their collateral in the protocol and they're not able to borrow another currency against their collateral. The reason this works so well in DeFi is because a lot of tokens are very volatile, and then we have stable tokens. So if you have a lot of ETH, you might want to borrow a stable token so you can spend it without spending your ETH, which might, go up in value or down in value quite dramatically. So here we have Sarah. So Sarah wants to have some ATK, which is another made-up token, so another token. But she only has tokens. But she doesn't want to sell her tokens because obviously, the price could go up and then she'd have lost all this money. So instead, she decides to borrow ATK. So Sarah puts 100 tokens at $200 per token into the money market protocol, right? So the value of her position here is $20,000. Money market protocols, all of them will have a collateralization ratio, which is how much collateral you have to have against how much you borrow, right? So this is the value of her position, her $20,000 must always be 150% of the value of the money she takes out. And obviously this is because, if token's a very volatile token, then there needs to be kind of a wiggle room for the price to move up and down, right? So this is why collateralization ratios exist. And these are determined by algorithms, depending on how much money is in the pool, how many people want to borrow, how many people want to lend, right? So Sarah's going to have to pay interest on her loan. And in total, she can borrow $13,000, right? At 150% with 20,000 in, she can borrow $13,000, right? But she's going to have to pay interest on this until she pays off her debt. So this $13,000 that she takes out is debt. So think of the house, right? This is the money I get from the bank. It's less than the money I put into the bank, which is a bit weird to think about. But that's how it works, right? So the interest rate, again, is determined by an algorithm. So depending on how many people are borrowing and lending, is how much interest rate you are going to pay. So this is only looking at it from the perspective of the borrower. Sarah is borrowing money. But on the lender's perspective, they would put in, say, like 1,000 ATKs, and then they would receive interest. And this interest, again, would be determined by, are there more borrowers than lenders? Then the lenders will get more interest. If there's less borrowers and more lenders, then the lenders will get a very low interest rate and the borrowers will get a very low interest rate as well. So it all depends on how busy the markets are and how much collateral there is in the market. So the advantages of this is you're able to leverage collateral. So if you have ETH and you don't want to sell it, you can borrow DAI against your ETH, be able to spend that and not lose that initial ETH, right? And lenders are obviously able to earn interest. Borrowers have to pay interest. And if your position becomes under collateralized, so say if the token price suddenly moves down and it's now only worth $100, what will happen in the background is that all the tokens will be sold on the open market to close the position and pay off the debt that was taken out, right? Which is why the collateralization ratio is, again, very important. So the next major topic that's kind of gotten a bit more popular recently is rebasing tokens. So what a rebasing token is a token that allows the protocol, so the team behind it, to change the balance of token owners. So this is a bit of a weird concept as well, right? So what this means is if Alice has 100 of these rebasing tokens, right? And these tokens are currently worth $200. And the rebasing team wants to rebase it so that one token is equal to $100, so half the current price, right? So what will happen is Alice's balance will go from 100 RBTs to 200 RBTs. So they just double the supply in order to halve the price, right? So this is very powerful to kind of control supply and price quite on like a very detailed level. And in a rational market, like if you double the supply, the price will halve. The problem is in the crypto space, the markets tend to be not super rational. So while this might work in theory, a lot of the times the price moves quite irrationally when tokens get rebased. So yeah, it can be quite weird, especially because the supply is not fixed. These tokens tend to be really highly volatile and just priced all over the place, which makes sense if you think like the supply is just doing crazy things all the time. So I've heard this compared to a stock split. So it's kind of like a stock split in that sense, except you could also go the other way. I could also halve the supply. So now instead of Alice having 100 tokens, she would have 50, right? So it can go either way, whereas a stock split can only go one way and has some legal implications. So that's rebasing. Okay, cool. So I think I still have time. So The next thing I wanted to cover, like briefly, is audits and security. Obviously, the DeFi space is really new, and the way smart contracts work, where you can only deploy them once, the security is really important, because if you deploy it with a bug, everyone's going to lose their money, right? And it's up to the individual investors to actually check that the protocol they're investing in is secure and is not a scam, which there are lots of, right? So audits, sadly, are not the be all and end all. There are a lot of audit companies out there that are different qualities of audits. So, you know, an audit by Open Zeppelin is top notch, but an audit by an audit company you've never heard of, that, you know, doesn't even, you don't know, is obviously a lot less valuable. A lot of it is reputation based. A lot of audit companies take it quite seriously if one of their audited projects gets hacked, and will actually stake money to prove that they are really determined that their audits are good. So yeah, audits are not the be all and end all. If you just read this little thing on the side here, like, even if a protocol does get an audit from a really good audit company, it doesn't necessarily mean their code is good. So for example, I'm not going to name and shame, but this is quite a major audit company that did this audit. And the protocol that gave it to them, the contracts weren't compiling. So the code did not work when they gave it to the audit company. This project did eventually get hacked, which I think you can kind of see why that would happen. Audit companies can only do so much. They are not intended to debug your code. They are intended to security check your code. And if you use it for debugging, it is going to end poorly. So as an investor, there are lots of resources for non-technical people to be able to read audit reports and be comfortable with how well the company actually did on their audit. So yeah, it's something to really think about when you're investing in a protocol, is to actually go dive into their audits, go dive into their code, and look at if this is a secure protocol or if it's just nonsense. Right, so questions.
Awesome. I think we have some here in the chat. If I can start reading a couple off, but I know Doug asked about flash loans. Or if you want to see them, I don't know if you can see them, Veronica, easily, or if you have your screen.
No, I can't see them. So would you mind?
Okay, I'll read it off. So Doug wrote, "Hi, you mentioned flash loans. I guess they are very short term, but where do you source them? Front running, markets, or market sandwiches?"
Okay, cool. So flash loans you can get from a few protocols. I personally know that Aave provides flash loan facilities. So yeah, they're very short term. So just to cover what they are, a flash loan allows you to borrow a large amount of liquidity. So say like $1 million worth of a token, do something with it, and by the end of the transaction, you have to return those funds. So it is, you have to, whatever trade you're going to do, you need to execute in one transaction, right? So that's why I went back to this slide. So they're often used in arbitrage because it works really well. So let's say here, Jessica, didn't have 100 tokens, right? So what she could do is she could take out a flash loan for $1 million, go into market one, buy $1 million worth of tokens, then go into market two, all in the same transaction, go into market two, sell her $1 million worth of tokens, and make a much larger profit margin in one transaction where she gets to arbitrage these markets. So flash loans come into play a lot with arbitrage. They also come into play a lot with hacking. A lot of protocols do not actually protect against flash loans, especially in the case where they only have one price oracle. So if your one price oracle is Uniswap and I take out a flash loan of $1 million or $5 million and then go flash loan the Uniswap market, the price is going to move a crazy amount, right? So you'll see here, if it was $1 million, it would move insane amounts. The price would be way off. And if you're only getting your price from one source, that would allow the hacker then to manipulate your protocol into thinking the price is much lower than it is, and taking a whole lot of money. A lot of major hacks happen with flash loans, arbitrage, and single oracles for price. And then the other questions were related to sandwiching and front running. So front running, what it is when you submit a transaction, you submit a gas amount with it, right? Which is how much you're willing to pay for that transaction to get executed and actually mined on the blockchain, right? So what front running does is, let's say you are going to buy 100 tokens on market one, but I want to arbitrage on market one. So what I do is I send a transaction to buy 1,000 tokens before you, and I just increase how much gas I'm sending with the transaction. So my transaction will get executed first. It'll get mined first. Then your transaction to buy 100 tokens gets mined. So now I've moved the price up. You buy tokens at this higher price, and then I sell my tokens after your transaction, and that's what sandwiching is. Because then I sell afterwards, and now you've actually bought tokens at a higher price than they were worth, and I made a profit off of your transaction. So that's front running and sandwiching in one description.
Awesome. Great question and answer. And we have 3 more questions and 3 more minutes. So
let's go.
Rapid fire. So liquidity mine, I guess it's a more common question, but it says liquidity mining looks very much like proof of work, ?
Kind of. So it's more like proof of stake than it is like proof of work. So proof of work is solving a computational problem, whereas proof of stake is providing liquidity and then receiving mining rewards from that. So it's more like proof of stake than it is proof of work, because you provide your liquidity and then you get rewarded for having your liquidity. It is different though, because you're not securing the network or anything, but you are in a sense securing the protocol and helping them maintain a good and accurate price.
Awesome. And then another one. So is Sarah both a borrower and a lender?
I knew I should have put a better example there. So no, Sarah in this instance is just a borrower. She is just borrowing ATK. She is not supplying tokens. She is supplying tokens in the sense that she has to supply her own collateral, but she is not earning interest from these. So she is a borrower because she is borrowing ATK tokens. A provider in this sense would only put one asset in. They wouldn't borrow against it and then would receive the interest payments from the people who are borrowing the asset.
Okay. Cool. Good questions, Doug. Thank you.
Yeah, these are great questions.
And then the last one here is this concept of rebasing what Polkadot applied some weeks ago?
I'm not exactly sure what Polkadot did a few weeks ago. There's a lot of projects in the space doing a lot of things all the time, so I'm not 100% sure what Polkadot was doing. Maybe if their supply suddenly doubled, then yes, or tripled, or like some order of magnitude, then yeah, that was it.
Awesome. Great. Then I think we'll close those questions for now. But if you think of any more to ask, even Veronica, we're gonna have a brief time at the very end if there's any remaining questions after Paul's section. So feel free to keep posting them as well. But now I'm gonna bring on Paul Kohlhaas. He is the CEO of Molecule. And today he'll be talking about NFTs, IP, and data tokens, which are all very relevant topics right now. So that should be very exciting. Paul? There he is.
Hey, Paula. Hey, guys.
Hi.
Thank you so much for yeah. Thank you so much for the intro, Paula. Great presentation, V. Yeah, thanks. And thanks for setting this up. Cool. As Paula said, I'm the founder and CEO of Molecule. Molecule was actually incubated within Lunar for like, over a year last year. So yeah, it's quite exciting to be here and to be able to present what we're working on and the progress that we've made since then. So I'm gonna share my share my screen quickly. Cool. Yeah. Hi, everyone. Great to be here. So at Molecule, we're building an open platform and system to decentralize drug development. And our core goal is really to help scientists in the very early development stages in biotech and pharma get easier access to funding and really enable them to develop their therapeutics in a much more open way than the system allows today. If you really start thinking about how pharma works on a grand scale today, it's one of the most secretive, slow industries that exist. It costs on average $2.5 billion to bring a new drug to market, and it can take upwards of 10 to 15 years. And we believe that if we had a more open source and incentivized development system, drugs could come to patients and therapeutics could come to patients at a much faster pace, and be much more accessible to many people. So I've kind of just talked about this, but pharma is actually like in the midst of something called an innovation crisis. So it's projected that the rate of return on R&D that pharma spends is projected to hit 0% this year. So for many pharma companies actually going forward, it might be better to cut R&D altogether, because they're really failing to create new innovation. And so the majority of innovation today in drug development really sits in academia and in small biotech companies and in universities. And we're trying to build a system that really helps those scientists surface their innovation much more quickly and then get it financed by new public structures. And pharma really consists of these two distinct things, which is data around therapeutic assets and IP. And we're trying to bring both of those things onto a natively digital platform. And so we can ask, like, how did we get here? If you think how drug development works today, it's really similar to how software was being developed in like the 80s and 90s. So you had these giant software conglomerates back then that were trying to control the market. This was like when floppy disks and CDs were being sold. Think of how proprietary software was back then. And today, like most of our software is free, it's being developed open source. But pharma is really still stuck in this like 70s, 80s mode of creating big things in-house and only sharing them and monopolizing them once you can take them to market. And I just mentioned this earlier, so most early stage therapeutics today are developed in academia and in biotech startups. So a lot of people don't know this, but actually only about 12% of all like new drugs that are being developed sit in pharma companies. The rest, so 88% of all drugs actually sit in biotech and in academia. And what pharma then typically does is they come in and they purchase these assets. But there's a huge funding gap here, which is called the Valley of Death. Because it's very difficult for early stage researchers in academia and even for biotech startups to often get funding for their new innovation. On the one side, you have public grant funding bodies that will give grants to researchers for this very early stage innovation. Or then you have biotech VC, which works as any normal VC works. And then typically, or you have those drugs funded by pharma, and then the drugs actually move directly into their value chain. But if you think about it, it's very difficult for anyone to actually get involved financially in this early stage research, become a part of it, or even openly access this. And so pharma in that sense is really a marketplace. On the one side, you have researchers that are developing new drugs. On the other side, you have patients and investors and companies that want to commercialize them and really bring them to the end consumer. And both of these sides are struggling to meet each other. And so this is what the entire drug discovery process typically looks like for some of you that might not know. So typically you have this discovery phase where, let's say you discover a new molecule, you then move that into the preclinical phases. So testing the molecule in mice, in flies, in human cell cultures. So these are the first lab studies. And then phase one trials are typically where you test the drug on humans for the first time. Phase two, you do large scale human studies. And then phase three, very large scale human studies. So actually most coronavirus vaccines, which I'm sure many of you are kind of watching or have heard of, are currently in phase two. What is, for example, being done in China and Russia, where China is already they're already bringing out these relatively untested vaccines. That's essentially almost like doing large scale phase 3 trials on the population. But so this entire phase here, I mean, it's vastly being sped up around coronavirus, but this entire phase takes 10 to 15 years. And you have to say it takes so long because no one here is working together. Well, they are, but this is all within single companies, or it used to be within one giant company. And so our basic approach is to say, what if this was being done in an open market? And what if data and IP around these assets was openly shared? And this actually came from a concept called that Simon de la Rouvière kind of first invented or came up with, which is a concept called curation markets, which also gave rise to the whole development around bonding curves that we're seeing today, and automated market makers, which are really, so automated market makers, as Veronica just described, are really information markets where people trade up and down in a certain asset. I mean, that the token can represent anything. It can represent a meme. It could represent like whatever kind of floats your boat. And in the same way, we can now create, imagine if all of these are individual molecules. Imagine if all of these are new therapeutics. Imagine if all of these now had an associated market where people could go long and short on the respective asset. And through that, you can surface information in the market a lot more effectively. Cool. So essentially what we're building a marketplace for researchers to host their IP and their data. In return, they receive funding and equity in those assets. You have investors and patients that can invest into the assets, in return receive equity. And then you have pharma and biotech companies that can buy or license the IP, and in return also fund the development of these assets. Very high level overview. What does that actually look like from a product perspective? So you have to imagine you come onto our marketplace and you see, so these are all tiles of individual research projects that are in the early phases of development. You'll have the researcher working on it, a specific university that this is being developed in. You could then click in and obviously see a lot more about the opportunity, what is being developed here, who's working on this, what are the different phases, what are the funding requirements. And so a really big first step for us is to surface all of this innovation in the first place. Like, how do we actually, we looked at the market and we said, like, how do we actually find this stuff? And then how do we get it financed in a better way to really speed up this process and make it more open. And this is then where our tech stack really comes in, which kind of brings me to, I think, what the goal of the cause as well. So we have various components in our tech stack in terms of how we can actually make this happen. And really our goal with these things is really to almost create virtual pharmaceutical companies or virtual pharmaceutical cooperatives that now own an asset in a decentralized fashion and collaborate in a decentralized fashion on its development. And the key components around that are really making IP natively digital by attaching ownership to non-fungible tokens. The second one is then tokenizing IP ownership and distributing it to multiple stakeholders. So once you make the IP digital, we say, okay, now let's spread it in the same way that we spread equity in companies. We spread that between multiple people that are working to develop that asset. Then we create liquid markets around that using similar mechanisms as Veronica described, using bonding curves and automated market makers. And then the last part is really starting to think about governance of this IP and governance of the data via decentralized autonomous structures. Cool. So NFTs and IP, I think, are a really interesting technical combination. And it's already very much being done at scale. If you think through, crypto kitties are essentially IP. Artwork is IP. So we have different forms of IP, but intellectual property is typically kind of a time-stamped claim of an invention or a creation. And there's very different forms of IP. This is a non-exhaustive list. There's trade secrets, patents, copyright. And so we specifically focus on biopharma patents and IP. And IP can be broad. So I can have IP. I mean, this presentation is IP. Like lots of things can be IP, but there's a difference if your IP is recognized by the government. So this is where a patent comes in. A government has granted you the exclusive usage right and commercialization rights for a specific period of time. And patents there's been zero innovation around patents really for the past 60, 70 years. Like the legal contracts work the same in the way that the US Patent Office works, European patent offices work. There's been extremely little innovation, but it actually makes so much sense to have patents as a digital asset. And I think this is where NFTs get really interesting. So what they can really enable are making patents very easily transferable and discoverable, making them priceable, which is a huge issue. There's no good active patent markets today. And then the last one is really composable. And this is where DeFi gets really interesting and the composability of these assets. So for example, we can now bundle these NFTs into portfolios. So maybe you've typically heard that a company maintains a patent portfolio, even a single drug. So if we think at the end of this phase, when you get a drug in the pharmacy, there's normally about 30 patents that relate to that specific drug. So you really create bundles of therapeutics around, bundles of patents around therapeutics. So now we could bundle these NFTs into portfolios. We can also refractionalize them via ERC-20s. So essentially now saying, cool, now let's create a market for a single patent. And through that, enable funding mechanisms and make it priceable. NFTs and patents are also really tricky, and it requires extensive legal engineering. So patents really need to be registered to specific legal entities, and a change in ownership needs to be registered with the patent office. So it's not as easy as sending around a CryptoKitty. You would need to constantly update the owner like the real world legal owner. Although so one way to get around that is to simply place the patent into a special purpose vehicle and then attach ownership of that to the NFT. So then you always have the same legal entity that actually holds the IP. This is an overview or just a screenshot that I just took earlier from an NFT marketplace that I go to now and then. It's called Rarible. I'm sure maybe some of you guys have been on it already. And you'll see what the basic UI looks like, and you'll very quickly get the idea. You see the top sellers of the day, and you have different NFTs that are listed here in different areas. And while we're pretty far away from that, like this UI is not that different in the sense of, imagine now if each of these therapeutics that are being developed are backed by an NFT, and you're making that NFT discoverable. And I think and while this is an extremely playful implementation, obviously, not obviously, I mean, like what we're trying to do with Molecule is like much more, I think much more serious in terms of you dealing with IP and medicine. But fundamentally, from an infrastructure perspective, what is being traded and exchanged is not that different. And I think that's something that's incredibly exciting about this use case. Yeah. This is a concept that we've worked on for years, and I think we're slowly getting there. There's been so much innovation in the space. I mean, just making combining bonding curves and NFTs and making the IP refungible, kind of what I described earlier. And I think having markets around these things gets really interesting, because you have to imagine that positive research data that emerges will now increase the price of an asset, whereas negative data that emerges around a particular therapeutic area would decrease the price. So it might be that, like, if all of these things have public prices now and new data came out, someone on this market in a similar way that here would decide to sell their asset or decide to buy into it based on new data emerging. And I think that's where I think these concepts get really powerful, like rethinking pharma as a marketplace, as opposed to being siloed within single companies. Cool. I want to do a super quick retro as well or just present what we launched at the beginning of this year, because I think it's a really exciting use case for DeFi, and it came quite early. And this was what we launched in mid-January, which was Molecule Catalyst. And massive shout out to the entire Lindum team who really helped us build and launch this successfully. It was, on the technical side, a roaring success. If you ever need any work done on bonding curves, I'd wholeheartedly recommend Lindum. It was less of a success from a go-to-market perspective, and that's really kind of what I want to showcase here and walk you guys through. Paula, how are we doing on time?
We're actually doing really all right. So it's 45. So I'd say you have like 5-7 more minutes to go, and then we'll do some questions for you, and then close up with any questions that anybody has for both of you.
Okay, that's perfect. So what we did with Catalyst was really, we tried to take these concepts and build a first MVP around how to use crypto and these new fundraising designs to fund research. And so the way that Molecule Catalyst really worked is funders would contribute DAI into research projects that they wanted to support. In return, the funding would go on to the researcher. The researcher would upload their research data, and then funders would receive unique project stakes in the research that they funded. At the time, we didn't have the funding available as a team to really invest heavily into the legal engineering. which means that these project stakes were essentially just donations. So this was a donation-based system, like a Kickstarter. You would say, this piece of research, I want to fund this. Let me put some money into this. And this was the first study that we funded, or partially tried to fund. It was a high-impact clinical trial to study the effects of microdosing psilocybin. It was with the University of Toronto and the Toronto Centre for Psychedelic Science. I can gladly say I think that the study has kicked off regardless. It's a really exciting study if you're interested in that field. So how the fundraising mechanism itself worked is essentially it used token bonding curves as a mechanism that governed token distribution and pricing. So you'd have a certain amount that would be staked. Let's say I invested 100 DAI, 75 DAI of that would go into the research funding and 25 DAI would become a project stake. And then the thinking was, as more people contributed to this bonding curve, eventually you would hit a point of break even if enough people contributed after you. And I actually think, Veronica, correct me if I'm wrong, this was one of the first live bonding curve implementations on mainnet. Or at least for
it was definitely in the first like 3 or 4.
Yeah, super exciting time for us. We very grateful for all the community support that we got. It was also quite a difficult time. I think we got 100 of unique interactions with the smart contract. Unfortunately, we only reached about 10% of our target, which isn't bad. So we raised about 5,000 DAI in donations, or just under 5,000 DAI in donations for this first microdosing study. But unfortunately, you can't start a clinical trial with like $5,000. You just need a certain amount. And we realized that the amounts that we were going for were like way too high for people to just donate. And I think for the traction that we were at that stage. Additionally, what happened, I mean, I think we launched this in mid-January and Corona really started taking a toll on the world in mid-February. The fundraising campaign was geared at 3 months, but at the end of February, beginning of March, it seemed a little bit silly to raise funding for like a donations for a psilocybin trial when like the world was burning and like Ether was crashing to like $80 and Bitcoin was at 3,500, and it just like it was difficult to convince people at that point. And I think, but the biggest lesson that we really took away from this is like, if you build any of these systems, and I think this is really for people, this is valuable for people that are trying to combine the real world with the crypto world. DeFi is, I think, really working so well at the moment because it's not really interfacing with the real world. It's like everyone's like, yay, magic internet beans, and we can create all these cool systems. But like how is it impacting real people? That's the difficult part. But so I think one of the biggest learnings that we had from this was how to engineer your user base for success. So if you think of these two Venn diagrams, we just had to ask ourselves like, how many people are interested in funding biotech and, for example, psychedelics? I'm sure there's many in the world. But then what is the overlap with people that own crypto? Actually, surprisingly, there is an overlap, but then we have to go a little bit further. How many of those people that own crypto actually own DAI and can interact with our system? So the requirements would be owning DAI and having MetaMask installed. If you don't have that, then you're kind of like, sorry, you can't like participate. And then how big is the circle of people that understand bonding curves, which in January was very small. And so I think in this first version of Catalyst, we really over-engineered this, or didn't engineer our user base for success. From a technical perspective, from a technical perspective, everything worked beautifully, but often, I've seen many great blockchain projects build very sophisticated technical solutions and then just fail because, like, I think with a couple of conversations, you could have come to the point of realizing, hey, we need to change this and that in order to actually address a core user base here. I think that was one big takeaway. And the last big takeaway is you have to invest into legal engineering. Yeah. If you're dealing with the real world, you need to invest into legal engineering. There's no way around it. Yeah, so just some insights, dealing with real world assets, focus on legal engineering first. Also build a community around the asset prior to launch. and then launch internally and then have it externalize it rather than do a big public launch. Never underestimate the marketing with these things. I think that's being redefined in the DeFi space now, but in the DeFi space currently, you have so many projects trying to launch and build communities around them. And then this is less, I think back then this was very true. It's improved dramatically already. I mean, back then the UX for non-DeFi native users was a massive problem. So we try to convince researchers to use these systems, and the researcher that we were funding and things like what is DAI, how do I install MetaMask, actually the onboarding was quite a challenge. The UI around bonding curves was surprisingly not a big issue, and I think like AMMs have almost like abstracted away the complexity with bonding curves. And then DeFi liquidity for, I think, non-crypto native use cases is still small, but I think it's increasingly growing. And we're quite confident to relaunch a experiment like this in like the relatively near future, specifically because we've heavily invested into legal engineering. Yeah, actually, this is one of the upcoming projects that we have and that we're really excited about. We've been working on this project for over a year. And it's a series of longevity drugs with the University of Copenhagen and a laboratory called the Scheibe-Knudsen Laboratory. And yeah, they've identified over 10 potential molecules that have a very high potential of having anti-aging properties. So you take these drugs, you can not live forever, but could live substantially longer. Yeah, it's a super renowned project with a great researcher, and we're in the current process of setting up a financing for this project. Maybe as a last point, kind of what's next on our roadmap. So this, what I showed you earlier, this part of our platform is really what we call like the discovery layer. And here, crypto is very much in the back end, if anything. So you can list your assets, you create these project pages for your therapeutic project, or we create them, which is basically just putting in data and making something discoverable at this point. And we're expecting that at the end of the year, we'll be at about 100 plus projects and really growing from there, where we're just listing these projects initially to be discovered. On the other side, we're building an active demand side with biotech VCs, pharma companies, and patient groups who are interested in this early stage innovation. And then the other layer is the transactional layer. So actually getting these projects financed and working on the technology to do the financing in a decentralized way and distributing ownership. And through this large supply side, we're essentially creating a funnel of fundable projects, because this new approach is not suitable for every therapeutic project or every setup. So this approach really helps us identify the projects that are suitable for this. And then something that we're very actively working on, I didn't get to that today, but we'll be publishing something about it soon, is really concepts around tokenizing research data and IP at the same time, and separating the two. And there, I'm sure some of you guys saw it or have been watching. We've been a big fan of Ocean since its early days, and Ocean just launched V3 of their marketplace, which means you can essentially create data tokens now using Ocean and tokenize data sets. And that's something that we're also very actively exploring around fundraising mechanisms. Yeah, I want to cap it here. Sorry, did I go over time a little bit?
It's fine. We still have a couple minutes to go through questions, but thank you. No, that was a really cool deep dive. And yeah, I feel like getting into some of these real world applications through this DeFi space is something that I feel like the space is very much working on, but we are definitely making some good improvements. So yeah, that's very, very cool. And we have a couple questions, comments in here. So I'm just we have one from Doug as well. So it's data science is a key part of pharma research, data from NHS, et cetera. And pseudonymization of data is critical because of regulatory constraints. This will be an obstacle to opening up the incubation market. That one's more of a comment. I don't know if you want to comment on that comment.
Yeah, Doug, great comment. Very deep question. So I think you're talking about who accessed the data when. So if you open up all of those data sets, and that's something that you can actually track very easily using blockchain. I mean, you could use even existing database structures to track this. Something that we're looking into a lot is like privacy preserving features. So actually, how can you keep the data? How can you open up the data, but at the same time, serve its privacy? And Ocean, I found out about this earlier today. Ocean has if you're interested in that, Ocean has
Ocean Compute.
Yeah, Ocean Compute to date, which really focuses on that use case. Like, how can you sell, buy, or access data while preserving its privacy? I think those types of questions are early for us, though, Doug, in the sense of that I think we're trying to go at this at a step-by-step process. And I think actually getting our platform to a stage where we can now also host data, so all of the preclinical data sets, is probably like a 1 to 2 or 3 year goal. But it would also make the platform much more usable. So as a pharma company, for example, if I can quickly look at one of these assets and also start accessing all of the data sets around it, which is normally a process that can take 6 months of signing NDAs and yeah.
And then tacked on to that, afterwards, a little bit later, he put, are you using, I mean, maybe you just answered it. Are you using blockchain to track the provenance of the evolving new drug?
Oh, I think I answered that, right, Doug? Yeah.
Yeah, I thought so. As I read it, I was like, yeah, you answered that. And then comments from Alex Conway is trading fractionalized patents is super interesting. Mm-hmm. And then the question afterwards is, how do you price the NFT, which you did touch up on a little bit?
Yeah. I agree that it's super interesting. I mean, the easiest way to price it is by the fractionalization itself. I mean, once you fractionalize it and people own fractions of it, those fractions will have a value. Yeah. Cool.
And then,
and then, well, the other thing is, how do you price IP in the first place, or how do you price patents in the first place? And it's always like it's auction. It's normally like auction mechanisms, or just I'll be like, I'm willing to pay 1 million for this, and you'll be like, I want 5, and then we'll be like, let's meet at 2.5. But that's obviously a very inefficient process, actually, because we have information asymmetry. So actually, if you have an open market do that, the market is much more likely to find the true value of the asset. And something that we hope to do as well is, with a lot of these universities, we're standardizing licensing terms. A lot of this, actually, the first step is then actually to out-license the IP from a university or a biotech company. And there you need to have licensing terms. And that's also a huge problem in the industry, that none of that is standardized. And you can actually, creating standardized pricing mechanisms for this IP is something that is hugely valuable for the industry in itself. Yeah.
Awesome. And then one last question and 1 more minute, so that works out. From Alex Conway again, why only accept DAI? Can use Uniswap to accept deposits in any asset?
Yeah, we did actually integrate Uniswap, so you could have contributed in any asset, and Uniswap would have just swapped it into DAI. The reason to only accept DAI was because having a multi-currency bonding curve contract would have been insanely complex. So I'm actually wondering, Veronica, are there like?
No, there are none.
Okay.
Because the bonding curve, obviously, it needs a price. So like even in AMMs, it's only 2 assets ever. Yeah, no, no.
Awesome. Looks like we're right here, basically exactly on time. So great job to the 2 speakers for really timing that one out really properly. So if there's any other questions, we are about at time, but if it's a quick one, we can answer it. If not, you can feel free to email me, paula@linumlabs.com, and I can forward you to the right speaker, or if they want to share their emails, they can too. But thank you so much for everybody joining today. We're going to be doing these community calls a lot more often again, to just back out into the community for you guys. And if you do have any questions, whether it be related to any of the talks you heard today, or are interested in maybe doing some bonding curve or NFT work of your own, or just chat about it, feel free to email me and we can chat about it. And other than that, thank you. And the recording, I think we will have a recording of this. So if you shoot me an email, Nestor, Paula at Linum Labs, I can get that for you. Or our YouTube. But we have most of your emails from this calendar invite, so we'll send a little follow-up email here with some information on follow-up stuff. But thank you everybody, and thank you Paul and Veronica, super awesome presentations, and thank you everybody else for joining, and have a wonderful evening.
Thanks so much, Paul. Thanks, V. Thanks, Paula. Catch you all soon.
Thanks, everyone. Have a great evening.
Cheers.